Welcome back, everyone. Today we're going to talk about uranium on a longer, larger time scale and about some constructive things that's happening in the industry. The emphasis, the operant word and idea and concept in today's piece is time. Whether that's a couple of years in the future, we'll see things in a 3 to 7 year time scale into the future, and then we'll end things on projections all the way out to 2050. Now, you could say you don't care about 2050, you're trying to make money in today or tomorrow or near term. But let's look back very quickly over the last 5 years, or not look, but let's think over the last 5 years. Had you bought 5 years ago Cameco at around $10 or $11, in which it traded in that range for quite some time, you would be up roughly 150% on your money. Now, that's 5 years. That's 150% over 5 years, which is to say that you made 30% a year. Now, that's nothing to bat an eye at. That's actually relatively good. Actually, you could still be in the money today if you timed your purchases correctly. It's only within the last year and a half since around Cameco's trading roughly where it was in November of 2021. So we'll call that a year and a half. It's pretty much in the same price. So in the last year and a half, you've made no money. You've collected a paltry dividend, and that's that. And then you could say, I've waited long enough. And we'll end this slide deck off with a chart that shows you how uranium moves, which is not much of anything and then a lot suddenly. And what you're doing is you're buying optionality to something that's not necessarily imminent but inevitable insofar as your theory goes. So I understand that I might not be invested in uranium come 2050 or even 2030, but the base case is that things continue to improve and sentiment continues to improve, and that the spot price and market and contracts continues to improve. And that's the name of the game. And insofar as that continues incrementally and progressively, then the underlying fundamentals, which is theoretically what the stock price is predicated upon, will improve. And therefore your returns, capital returns on the stock should improve. And patience is key. Sometimes it takes longer for things to inflect than you'd prefer, but if you wait, you can get paid. That doesn't mean you will get paid. What I'm saying though is that that's your best bet. With that out of the way, I made this a week or two ago, and I put out last week's video, which I would recommend you go watch if you haven't, because I kind of just thought that was more pertinent and more exciting and less dull. This has some reading involved, but is what it is. And just sit back, listen, enjoy it, reflect on it, live your life. So Warren Irwin, which if you don't know him, look him up, listen to him. He's been a guest on numerous podcasts. He's a uranium bull. He's more of a base case, improving fundamentals type person instead of rocket ship emojis and to the moon like other people are. And he came out a few weeks now, saying uranium. It sure feels like a uranium bottom forming in here. Uranium stocks are off pretty solidly. Hype has backed off. Uranium vehicles trading at a discount to NAV. Spot has flatlined for a long time, which is often an indication of an upcoming move. We'll see. Now, he's actually one of the longest commodity fund managers in Canada. Respectable individual, smart guy, been in this both the uranium sector as well as the commodity sector for decades. He's someone worth giving a listen to. So that's my appeal to authority. So the first piece, we'll do this one and then we'll discuss the Department of Energy piece they came out with and cover some charts with that. So let's get in this. On the verge of a crisis, the U.S. nuclear fuel Gordian knot. At crucial stages, mining, conversion, enrichment, and even downblending capacity could be added. But all of that takes time, and very little in nuclear industry happens promptly. Given that it's not economically advantageous to add new capacity to a market that's already fully supplied, there should not be any surprise that there isn't sufficient capacity outside of Russia, says NEI's Kotek. The government wants our utilities buying Russian uranium for a long time. Pivoting isn't something you do overnight. So here we go. Industry happens promptly, overnight. This is a time scale issue, people, and it takes time to play out. And it is what it is, and if you're going to be involved in this name, then that's what it's going to be. Centrus is currently still the only private sector play in enrichment. They, along with two government-owned companies, Urenco, which is a British-German-Dutch company, and Orano, a French company, are the three major players with the capability to scale up to make the West independent of Russian enrichment capacity, but nowhere near fast enough if supply is cut off soon. And the enrichment companies are nowhere near starting to add capacity because nobody is sure that the investment would ever pay for itself. Look at that, Economics 101. They don't want to expand to handle this current issue, and in a year or two we're friends with Russia again. And they're going to allow them to come back into the market, says Kenneth Peterson, former vice president for nuclear fuels at Constellation, formerly Exelon Generation, and vice president-elect of the American Nuclear Society. David, vice president of Centrus, summed it up this way: with Russian capacity in the market is oversupplied with enrichment, but it would be savagely undersupplied without Russian supply. That creates a lot of uncertainty that inhibits investment. If sanctions are imposed by either side, he said, the commercial path would not be made any clearer. They bring a lot of uncertainty. How long will they last? Who will join them? How rigorously will they be enforced? He added, uncertainty is the enemy of investment. From a commercial standpoint, that position makes sense to the suppliers, even if it creates problems for the generators that market themselves or their reliability. The crisis, it turns out, isn't just in enrichment but also in conversion, the process of turning yellow cake into UF6, which is the form that goes into centrifuges for enrichment. How much uranium the industry needs and how much conversion isn't a simple question, because the two processes are connected in ways that are not instantly obvious, and a shortage of one can increase the demand for the other. This is because enrichers have two different ways to produce their output, which is usually UF6, enriched to 5%. They can start with a lot of uranium. Right now we're going to get into the underfeeding versus overfeeding dynamic. So they can start with a lot of uranium with a natural concentration of 0.71% and invest minimal separative work units on it to produce the desired output, leaving a higher concentration in the tails, the depleted uranium, between 0.23 and 0.3%. This process is called overfeeding. But if the price of enrichment is cheap, they can take the opposite strategy, underfeeding, and process less uranium but pluck out the U-235 more thoroughly, leaving tails with a concentration of 0.12%. Prior to the Russian invasion, when enrichment was relatively cheap, utilities specified underfeeding. This cut their conversion costs and lowered costs overall, but it made life miserable for the converters. Life also gets harder for converters when external events push down the expectations of demand for uranium. ConverDyn, located in Metropolis, Illinois, shut down in 2017 when the market price of converting a kilogram of yellow cake in UF6 hit $4. All Japanese reactors had shut down after Fukushima, some permanently, some temporarily, and Germany was closing its reactors, further driving down the market price of conversion enrichment. Low prices gave the utilities little incentive to build inventories, making the business environment for the miners, converters, and enrichers even worse. Remember the timeline we've talked about? I'm interrupting here, it took pretty much a decade-long bear market in uranium to really just squash everyone. Throughout the whole logistical chain, from the converters to the enrichers to the shippers to the miners to everyone. And now we're catching then, well, I guess we're 3 or 4 years into the inflection of that. So time scales, everything, yet again, if you're trying to make quick tendies in the next week or two, trying to degen YOLO some Cameco earnings calls, then you're playing this sector all wrong. And that's why I'm trying to emphasize here. I continue. Now there is a conversion shortfall, and the pricing conversion is up tenfold to $40 a kilogram. The shortfall further reduces flexibility in the supply chain, flexibility that would be helpful in case of Russian cutoff. The shortage of the enrichment in that scenario could be alleviated by moving to overfeeding, pushing more natural uranium through the system. But that's not possible if there's no way to convert the extra uranium into UF6. Call it Muir's Law. Everything is connected to everything else. Adding conversion capacity is probably a 4-year process, experts say. ConverDyn said that it would restart by the beginning of 2023. And by the way, they're running late on that. And scores of technicians have been hard at work at the 50-acre site in southern Illinois, set within a 1,000-acre property on the north bank of the Ohio River. By the way, ConverDyn is owned by Honeywell, in case you're wondering. But the job has taken longer and costs more than anticipated, executives say, and it is restarting with half its former capacity, about 7.5 million kilograms per year instead of 15 million kilograms, according to experts. Between ConverDyn and converters in Europe and Canada, total capacity is around 32 million kilograms a year. Without Russia, there would be a deficit of 10 to 12 million kilograms. According to Critchley, ConverDyn and its competitors could expand capacity, but only in large increments. That means you need an awful lot of customer support in order to generate the incentive to add that capacity, he said. You can't really make decisions until you've got a lot of support, he said. But getting that support takes time too. He said that adding enrichment capacity probably had a longer leading time than adding conversion capacity, but that right now it doesn't matter. There's a standoff at the moment, Critchley continued. The observation could also apply to the enrichment market. The long-term market for conversion is probably positive, according to Critchley, partly because small modular reactors, which seem likely to dominate new construction in the United States and quite possibly in Europe, use uranium less efficiently than do bigger reactors. Smaller cores leak more neutrons. That, combined with life extensions for existing plants, implies more fuel demand. Even better, the long-term market for enrichment is certainly positive, because most of the new designs rely on enrichments closer to the 20% upper limit of low-enriched uranium compared with the 5% commonly used today. Many conventional legacy reactors that now run on 5% enrichments may move to enrichments closer to 10% to permit longer fueling cycles, as well as the use of accident-tolerant fuel, a new type of fuel that can withstand high heat for long periods in the case of cooling loss. The materials added to make the fuel tougher also cut neutron efficiency, so they need to start with higher enrichments. Those factors are also in play in the enrichment market, and enrichers don't increase capacity without long-term contracts. While utilities generally shy away from very long terms because they could lock themselves into supplies that are well above the market price during off years, and it would be slow. We're probably looking at a 6 to 7 year program if we have a very robustly funded effort that could start right away, says centrists Leistokow. The story is similar at the mines. In a conference call with investors and analysts in February, the top executives of Cameco, the giant Canadian mining company, stressed the point: we understand that to create long-term value and provide supply reliability for our customers, we must build a home for our production under a long-term contract before we pull it out of the ground, said President Tim Gitzel. Grant Isaac, Executive Vice President and Chief Financial Officer, said Cameco is a proven, reliable, independent, and integrated commercial supplier, but it's decidedly not a risk taker. Isaac described the decision to build a mine to serve the spot market as a silly spot market strategy. So with that out of the way, to the second of two pieces. This one is going to be the Department of Energy Liftoff Report. You can read what this says, but the Department of Energy plays a critical role in accelerating the commercialization of clean energy technologies and enabling the nation's broader industrial strategy, blah, 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 blah. They're just here to inform you. It's good stuff. You can read this. This has gone on long enough. It doesn't matter. Let's move on. So, to the charts. So if you're listening, now it's time to look. In this report, which will be in the description, as well as links to the first piece we covered, waiting until the mid-2030s to deploy at scale could lead to missing decarbonization targets and or significant supply chain overbuild. And these two charts show you new nuclear deployment starting in 2030 versus starting in 2035. It's kind of like saving for retirement. Saving for retirement an extra 5 years, starting when you're 20 instead of 25, or 25 when you're 30. By the time it all adds up and compounds, you're looking at hundreds of thousands of dollars of difference, even though it's only tens of thousands of dollars that you didn't invest. Well, similar dynamic. And they really hit the ESG note hard in this thing, and for good and bad, both the bad ESG and the good ESG, which I'm not going to go into detail, and if you don't know what I mean, then I probably should go into detail, but I'm not going to. Nuclear provides a firm resource and system benefits that ensure reliability and stability across the grid. Nuclear power can help prevent blackouts in a future grid, which will be increasingly reliant on variable power sources. Firm power helps utilities provide a reasonable reserve margin through all hours of the year, especially during summer and winter peaks in demand and across weather conditions. And here, this is where they hit the woke, the DIE, diversity, inclusion, equity, ESG, environmental, social governance, if you're unfamiliar with the acronyms. Access to reliable and resilient clean energy resources is not equitably distributed across the U.S. Increasing grid reliability and resilience for underserved, overburdened communities can support improved health outcomes, public safety, economic security, and overall quality of life. And yes, that's all technically true. And I agree with it. So there you go. And here's a picture, U.S. capacity factor by energy source 2021. And this is what I mean by the time scale. Out of all these charts, this is the one that you really should pay attention to. This is why a nuclear reactor isn't just built overnight or over day, over week, month, or year. If you look at the fourth column, construction, okay? On the right side, you see the green bar that says construction. So that indicates that it takes a little over 3 years to construct a nuclear reactor. But that does not cover the excavation. That doesn't cover the site preparation beforehand. And it doesn't cover the commissioning and startup after the construction is said and done. And none of that covers the feasibility study and project plan, the licensing, and the design and procurement. and assuming that the supplies are there, that the labor to build it is there, and so on and so forth. So even if you started building it, which is what a lot of people say, they say, well, if you started building one, we won't have it for 3 years. But the reality of the situation is it's going to be more than 3 years. As this is showing, I mean, if you go from -5 to +6, we're talking up to 11 years. Now that's up to 11 years. It can happen shorter. China's doing a great job at not taking 11 years to build things. So maybe we can manage that too. Here we have building 13 gigawatts of nuclear energy capacity per year would require 375,000 workers, which is the size of a medium-sized city. Like, that's an entire city of humans. That's a good chunk of the population. I mean, it's a fraction of the population, but look at the labor markets currently. We couldn't, I guess as we grow, immigrants come in, so on and so forth. But somehow, if this all pans out, we're going to somehow need 375,000 people, and I'm not quite sure where they're going to come from. But it would require 375,000 workers by 2050 for construction, manufacturing, and operations. Roughly 100,000 would be required to operate the 200 gigawatts of reactors in 2050, and 275,000 would be required for construction and manufacturing. Many of these jobs are often union jobs with a significant ramp rate, so scaling up the workforce would require advanced planning and collaboration with unions to ensure trained labor is available. Expect this to be a sales pitch involving creating jobs for middle-class Americans and an opportunity for skilled labor and so on and so forth. You know, something like that. You know, just imagine if we fell into a recession the second half of this year, and then the presidential elections start happening in 2024, and then theoretically in all of that, you could talk about we need to go green, not just to save the environment, but to save America and the common everyday blue-collar worker or something. You know, there's always a nice spin. Yet again, there's nothing false about that. That's true stuff. So, but look for it to be utilized as a tool because, well, that's how politicians operate. Here we have equity and environmental justice. EEG. Advanced nuclear deployment can provide notable benefits including grid reliability and resilience, clean energy access and affordability, pollution reduction, high-paying jobs, and tax revenue to communities, including rural, low-income, or communities of color who face high levels of energy burden and energy poverty, limited or no access to clean energy, and high exposure to pollution from fossil fuel power plants. Polling shows that communities surrounding reactor sites view nuclear more favorably than the general public. Yet the benefits of these sites have not been equitably distributed, with the economic impact of reactors often benefiting whiter and wealthier communities. Nuclear fuel cycle facilities such as uranium mining and milling and the U.S. weapons program have disproportionately harmed low-income communities, communities of color, and tribes. So, if you can't appeal to a person's logic, then you just have to make things about class, race, sex, wealth, class, race, and sex. And then you emotionally prop people and then manufacture indignation and then say, oh, well, if they have it, we deserve it too. Give us the nuclear. It's almost like some kind of a what is it called when you reverse psychology and implanting a thought in their mind to make them think that it's their idea when it was yours. Because as we all know, you often can't logically discuss something of the pros and cons and costs of benefits. Instead, you have to trigger people emotionally and primally and have their hindbrain do the bidding for you. So if they won't buy in, because last week we discussed how educated people were more likely to support nuclear than not educated. and so on and so forth. And then the whole NIMBY, not in my backyard. And what happens here is, correlation equals causation, and then people get mad and envious and greedy and so on and so forth. So, but it's nice that they're talking about it, because they're hitting everybody. They're talking to the reasonable, sensible people. I'm like, hey, nuclear is good, and then they agree and say, yeah, let's do nuclear. And then there's other people, throwing tomato sauce on paintings, saying no more oil, and then you're like, yeah, but the white people have it. And then they're like, well, we need it too. Then, and it's like, oh, okay, so everybody wins, which is good. So now, what I was getting to in regards to patients is, you'll see these, insensitivity to sample size warning, because I have 3 sample sizes, which is going back. You'll see that over the last 3 years, roughly, that uranium consolidates, it breaks out, then it consolidates, then it breaks out, and then it consolidates. Now, it's not always going to happen this way. Maybe this is it. But we're still below the marginal cost of production. And that's before you factor in, because most mining companies mislead in a intellectually dishonest way when they say things like all-in sustaining costs. What they mean is not all-in costs in regards to sustaining some things. Of course, they don't word it that way because, well, how could they fool you? Because they don't factor in cost of capital, let's say, and they don't factor in the impairments and write-offs and write-downs on failed exploration projects, greenfield projects that never manifested or developed to anything, and as though that's not part of sustaining one's production. But I digress on that note. What's important here to see is that it takes time. And what you see is a breakout happens, a consolidation occurs for 12 to 18 months, roughly 9 to 18 months. And then within a matter of weeks, it massively inflects and then consolidates for another 9 to 18 months. And then within a few weeks, it massively inflects and then consolidates. And that's what it is. So since you can't time it unless you can, then you're smarter than me. Then, which isn't saying necessarily much, but not to be too self-deprecating, but that's what we're doing. We recognize this. We recognize this is the game in town, and we play accordingly, which is why you don't play short-dated options. And that's all I have for uranium this week. So, my portfolio update. Somehow, I've actually managed to my dismay, I've actually been positive every week this month. And not by much, like less than 1% each week, less than 0.5%. But every week, somehow positive, which with tech breaking out, Nvidia's closing in on near all-time highs, Apple, Microsoft, and pretty much the entire Russell 2000 is flat to down, and I pretty much own Russell 2000-esque cap-size companies. I got rid of my... I've been wanting to build cash, and maybe I'll touch on this in more depth if people care. I've been wanting to raise cash. And so I got out of my natural gas position. Natural gas shot up, 15 or 20% this week. I used that opportunity to get out my position. And it kind of sucks because at some point I figure it's going to make 100%. And then is raising cash, because by selling it, I went from 11% cash to 20% cash. And that's what I wanted to do. And it's taking me longer to build up a cash reserve than I want. So the only other option is to not buy things, which I did. I bought IAT, which is the iShares Regional Bank ETF. And I sold gas, ticker symbol GAZ, just call it natural gas, and pretty much all my names are just trading sideways for months now in some tight pattern, and so is much of the market. I mean, the S&P is in the same place it was 2 years ago. A lot of things are where they were years ago, let alone months ago. So I'm now in 20% cash, 21% cash, and feeling good about that. I plan on building up my cash reserves unless something catches my eye. If I had if I had a higher cash reserve, I would have held on to it. And maybe this is just all fancy post hoc rationalization for some sort of a prospect theory, which goes to explain that people lock in winners prematurely and yet hold on to losers, and they like to crystallize gains so they don't let their winners run, and then they let their losers run because they don't want to crystallize the loss via negativity bias and loss aversion. And I actually consulted my conscience before I executed the trade if that's what I was doing, and I concluded the answer was no, because I actually wasn't planning on selling it, and then I wasn't paying attention too heavily to it. And actually, when I went to buy IAT, I realized how much natural gas had ran, and the days before I wasn't. I bought IAT. I don't know. I also own KRE, which is the spider version of regional banks, and I'm satiated on that position for now. But by buying that, it was going to push me down to 8% cash, and I was like, do I really want to do this? And for a short-term trade, it was well played, because the next day it went up like 7%. And I was like, oh wow, but then Friday it closed down, a couple percent. So here I am almost at 5%, and who knows what next week holds. But if I had more cash, and it's interesting. So here my book is close to, I have, call it $700 in positions. If I wanted the ability to double down on those names at any point in the future, let alone enter new names, new positions, new opportunities, but for the sake of doubling down, as an example, I would need $700. Well, the problem is that I had like $100 of cash. And in order to get $700 of cash, that would take me 16 weeks at $42 a week. Which is to say it would take 4 months. Which is to say that it will take near September in order to build up enough of a cash reserve in order to double down on my positions. And the problem with raising too much cash is that you'll start underperforming your benchmark. And even though most of my names have a beta of 1.5 or 2 to the SPX, the SPY, the S&P 500, if it had a beta of 2, I could match the index to the upside with a 50% of my book in names. Now, I don't have quite that much alpha generation, if you wish to call it that, beta coefficient. So there's a delicate balance between being engaged enough with active positions that I still outperform my benchmark versus having enough capital on hand for opportunities when they reveal themselves. And that's something I'm trying to balance, and it's something important to get right. So I'm going to be in a cash building mode for the upcoming months, and I've alluded to that and have kind of spoken to that in prior videos kind of said it in passing about how I'm trying to build up cash, but I'm getting more and more serious about it, which is why I liquidated the natural gas position. Even though I think it has positive expected value over the coming quarters and months, it's more important and prevalent to me that I establish a proper cash balance. Now, I don't know what the France, I can't remember what it's called now. The French stock market was at all-time highs a couple of weeks ago. The Japanese stock market is at close to multi-year highs, or at multi-year highs. And then the CAC 40, CAC 40 is the French stock market. And then the Nikkei is doing well, and Nvidia is doing spectacular, and a handful of these big tech names are doing spectacular. And who knows? Maybe we see all-time highs in the S&P, but maybe we don't, which is why you have to keep a balance between cash and positions. And that's what I'm trying to execute on. I've not been more bullish and bearish at the same time since I can remember. And then to hear people like Stan Druckenmiller or Warren Buffett or I think Bill Gross, perhaps, someone else also saying similar things about the uncertainty in the short to medium term prospects for the market. They just don't know. Like, there's all kinds of bearish indicators, but then these other things are throwing them for a loop, and they just don't know quite what to make of things. And so you sit tight and manage your positions correctly and just wait for, as they, colloquially say, a fat pitch. And I'm trying to strike that balance, because at the end of the day, on a long enough time frame, you could call it a 3-year rolling average. But honestly, year to year, I want to beat the S&P. But if I don't, and I underperform slightly, say by the end of 2023, then so be it. In so long as I outperform, 2024, I mean, I'm happy to say, say that the S&P went up 20% this year, and I was up 10%. I'm like, oh, well, that sucks. But then if next year I can be up 20% while the S&P's up 10%, then it kind of balances out. But you really can't allow more than 2 or 3 years of that behavior before you really have to say, well, maybe this isn't just for me, and I should invest in the S&P, which is what the whole point of this channel is, which is trying to beat the S&P. Because to get an 8% return and or to beat the S&P, that's the name of the game. And the reason it's the S&P is because if I wasn't doing this, then I would just put this money in the S&P. That's why the S&P is my benchmark. You can call that home field bias. You can call it a lot of things. Selection bias. I mean, all kinds of things you can call it. But that is what it is, because that's what I would alternatively do. And I'm comparing the performance of this portfolio with the counterfactual example of the alternative world in which I would invest in the S&P. And so that's what I'm going to do, and what I am doing. And I think I've gone on enough about that. I've actually tried to refrain from these longer rants. I really would like to that's initially what this channel was going to be about, is me kind of rambling about my positions, updating people on, Kinross, or updating people on the natural gas, or so on and so forth. And a lot of people just don't care about some things, so they won't watch the videos, and there's too much variety and variance. But I really can't say I necessarily care about getting the optimal subscribers or viewers, because if that was the case, I'd post more videos, I'd post shorter videos, I don't know, be more emotional and put emojis and stuff in my titles. And anyway, I've gone long enough today. Thank you for watching, and until next time.